Are we in a debt crisis or are we headed for one?
In my opinion, we are at the beginning of a very classic late big cycle debt crisis when the supply-demand gap, when you're producing too much debt and you have also a shortage of buyers. What's happening now as we have to sell all this debt is we then do have enough buyers.
In today's video, we'll be diving deep into the growing concern of the U.S. debt problem. Renowned investor Ray Dalio has been sharing his insights on this matter, shedding light on the potential risks and implications for the 2023 recession. Unfortunately, the news isn't as positive as we'd hoped, as suspending the U.S. debt ceiling only exacerbates the underlying issue.
There's a lot of debt. It has to be bought, has to have a high enough interest rate. So a crisis, that's, if we continue down this path in terms of what's likely over the next, 5 and 10 years, then you reach the point that balancing act becomes very difficult.
So how did the U.S. accumulate a staggering $32 trillion debt for the issuance of bonds? And what's the deal with the recent suspension of the debt ceiling, and what are its implications for the nation's financial situation? The U.S. government has accumulated a significant national debt primarily for the issuance of bonds. These bonds, such as treasury bills, notes, and bonds, serve as IOUs, promising to repay the borrowed amount with the interest over a specified period. Primary dealers, usually large financial institutions, participate in the auctions, buying bonds from the Treasury and selling them to other investors. The government makes periodic interest payments to bondholders, representing the costs of borrowing. Bonds can also be traded on the secondary market. It's worth noting that the U.S. national debt is influenced by factors beyond bond issuance, including budget deficits and various government obligations.
The debt ceiling negotiations is ridiculous because it is not dealing with the problem. Look, there's a problem if you pass the debt ceiling increase again, because we're just going to keep piling on the debt. And there's a problem if you don't pass the debt ceiling increase.
It's important to note that the debt ceiling is a statutory limit set by Congress on the amount of debt that the U.S. government can issue to fund its operations. When the debt approaches or reaches this limit, the government cannot issue additional debt unless Congress votes to raise or suspend the debt ceiling. The implications of reaching the debt ceiling can be significant. Without an increase or suspension of the debt ceiling, the U.S. government may face challenges in meeting its financial obligations. It could potentially lead to a government shutdown, delayed payments to government employees and contractors, disruptions in government services, and a loss of confidence in the U.S. financial system. Furthermore, it may impact the government's ability to borrow money, potentially leading to higher borrowing costs and negatively affecting financial markets.
We're in the part of the cycle where the tightening of monetary policy to fight inflation begins to cause the cracks. And so you have to keep interest rates high enough that it compensates for inflation for holding it.
As the debt grows, making interest payments becomes more burdensome for the government. This diverts funds away from the other important areas, limits the government's ability to address pressing needs, and can lead to higher borrowing costs. Sustainability becomes a concern as debt servicing relies on spending more than the revenue generated, perpetuating the need for additional borrowing. Economic downturns can further strain debt servicing by reducing government revenue.
The value of money goes down. In other words, you could look at it very simply that if the quantity of money and credit, which is buying power, increases faster than the quantity of goods and services and financial assets, that the prices of goods, services, and financial assets will rise, the value of money will go down. And so we see that happening now.
The United States faces a significant supply-demand imbalance across various sectors of its economy. This imbalance arises when the demands for goods and services exceeds the available supply, leading to various economic challenges. One notable area affected by supply-demand imbalances is the labor market. The U.S. has experienced a shortage of skilled workers in certain industries, while simultaneously grappling with high unemployment rates in others. This imbalance has implications for economic growth, wages, and productivity. Additionally, supply chain disruptions, such as those witnessed during the COVID-19 pandemic, have further highlighted supply-demand imbalances affecting industries like manufacturing and retail. Addressing supply-demand imbalances requires strategies that promote skill development, workforce training, and improved coordination between educational institutions and industry needs.
Everybody received a lot of checks and all that money coming in, and people's paper net worth then went up because you got more money. And we're not used to inflation. But what is happening is then you're in that part of the cycle where there's that inflation pressure in goods, services, and financial assets. And what that has to do is then cause reactions. And those reactions are along the lines like people no longer will want to hold cash investments. They will not want to hold bond investments because those will start to have a negative real return. And as that inflation psychology and that investment psychology changes, it changes the movement of money. So it worsens the supply-demand picture for money.
Several factors contribute to U.S. citizens choosing not to invest in cash bond investments. This includes low interest rates, inflation risk, the opportunity for higher returns and alternative investments, the desire for portfolio diversification, liquidity needs, and personal financial goals. Low returns, inflation eroding purchasing power, and the availability of potentially higher yielding investment options often influence individuals' decisions to explore alternative investment avenues. These financial objectives play a role in the choice to forego cash bond investments.
They have to be smart, and they have to have a commission in order to work and agree on a plan. Imagine a bipartisan agreed-to plan. That is smart, and they have to have enough time. Maybe that's a year or two, but a bipartisan group of people who understand economics and engineering, and then deal with enough time to be able to put that together is what is required.
There were concerns about a looming debt crisis in the United States. The country's growing national debt, coupled with unsustainable fiscal policies, raised worries about the long-term economic consequences. The increasing debt burden, challenges in debt servicing, and potential risks to the economy and financial markets were some of the factors contributing to these concerns. Addressing the impending debt crisis requires prudent fiscal management, sustainable budgetary policies, and effective strategies to reduce the debt burden. Like what Dalio says, it should be prevented quickly before it happens. As we conclude this video, it's evident that the U.S. is facing a significant debt problem, and its resolution remains uncertain. The challenges lie in servicing the debt and addressing the supply-demand imbalance for U.S. Treasuries. Additionally, the decisions made by the Federal Reserve and the impact of the geopolitical tensions will heavily influence the outcome. Stay tuned for further updates on this critical issue. Don't forget to like this video and subscribe to our channel for more insightful content. Thank you for watching, and we'll see you on the next video.